Dear friends, welcome to Weekly View on Markets. Markets lost around 5% during this week, led by large cap sector. Mid cap and small cap sector lost around 3%. Fear gauge index, that is India VIX, has jumped by around 15%. So that shows that there was heavy fear in the market. Data indicates that weak hands are getting out of the market due to fear of fall. Market history tells us that when weak hands are flushed out of the market bottoms out and next up move starts. So the charts at present somewhere indicate that kind of pattern. We will discuss the charts later. So stocks have to be in the strong hands for the markets to move up. When stocks are in the weak hands, generally markets will not go up. So when the weak hands are flushed out of the markets, that is the time market bottoms out and starts moving. Strong hands are institutional investors and experienced investors with good research capabilities. And weak hands are the retail investors without proper research capabilities. They trade on looking at the market prices, stock prices, and then when market falls, they will get out of the market due to fear. Technically, markets are near intermediate bottom, and the recovery and consolidation is expected in the coming week. Now let us look at performance of indices during this week. Nifty lost 4.77%, that is 1,180 points, closed at 23,587. Bank Nifty lost 5.27%, that is 2,824 points, closed at 50,759. Mid cap index lost about 3.53%, that is around 2,084 points, closed at 56,906. Small cap index lost about 3.57%, that is 693 points, closed at 18,714. India VIX is at 15.07. It has gone up by more than 15%, indicating heavy fear in the market during the week. Now let us look at sectoral performances. Almost all the sectors except pharma lost during this week. Public sector companies which have run a lot in last 1.5 2 years have lost the most, that is 6.79%. Metal sector lost 6.63%. PSU banks have lost 6.34%. Commodities, energy, infra all lost around 6%. NBFCs, private banks, auto sector, oil and gas all lost around 5%. IT sector, manufacturing, consumer durables, media, realty, FMCG all lost 3 to 4%. So only one sector that has stood out the route in the market is pharma sector, which has gained 1.55%. The declining number of sectors and declining stocks were almost four times than the advancing stocks. There was a heavy fear and heavy sell-off in all sectors across the market caps, large cap, mid cap, small cap during the week. Now let us look at technical charts. This is the daily chart of Nifty. After giving a inverted head and shoulder breakout, Nifty had gone up to 24,800. From there again it has given a reversal, and this red candle on Friday indicates a bearish engulfing pattern. And where is the next support for Nifty? Nifty support is at 23,350. 23,350 to 23,400 is a good support That is where the reversal has taken previously. That will act as a good support. So by looking at the chart pattern, I feel that the recovery is somewhere around the corner. There will not be much fall from here, and investors should look at picking up quality stocks at present levels. This is the chart of Nifty Midcap Index. Here also we can see a big red candle formed on Friday. This is called bearish engulfing. Next support for Nifty Midcap Index will be at around this long-term support. Previous it has taken a support at this level and gone up. So this should be at around 55,200 levels. So Nifty Midcap Index can come down up to 55,200, or it may reverse from the current level. Even if it drops, 55,200 level should be a good support level. Investors can look at accumulating good stocks at these levels. This is the chart of Nifty Small Cap Index. Small Cap Index also has given a bearish engulfing pattern on Friday. And where is the next support? Next support for Nifty Small Cap Index is at around 18,000 level. Current level is 18,700. So there could be a fall of around 700 point, and from there it will show a recovery from this support, or it may show a recovery from the current levels also. So I have looked at macroeconomic data. Looking all that, I feel that recovery is somewhere around the corner, or there may be a few days of selling. After that, the recovery may be there in the market. This is the chart of Bank Nifty Index. Bank Nifty Index has good support at around 50,000 level. 50,000 to 50,100 level is a good support level for Bank Nifty, and from here I expect Bank Nifty to stage a recovery, or even next week the market may stage a recovery from the current level. So even if there is a drop, that is the time you look at picking up good quality banking stocks. Now let us look at some of the market and economic fundamentals. Why the markets have fallen so sharply during this week? There was Fed meeting in US at the beginning of the week, and they cut the interest rate by 0.25% in US. The rate cut is good for the economy as well as for the stock markets. But why the stock markets fell down? It is because of the hawkish commentary given by the Fed for the year 2025. Earlier, they had planned that there will be four rate cuts during next year, but now they have become hawkish. They fear that inflation might go up in US, because of which they have told there will be maximum only two rate cuts in the coming year. That has spooked the markets, and not only in India, all the global markets, including US markets, have fallen during this week. RBI Forex reserves is at a high of 652.8 billion US dollars this week. This is quite a good, comfortable level. But one bad thing is that rupee has weakened a lot. For the first time, it has crossed 85 rupees per dollar and closed at 85.02 per dollar, Weakening dollar is good for exporters, but it is bad for importers. So India's oil bill may go up, but good for IT companies and export-oriented businesses. Dollar index is at 107.82. We can see that dollar index has moved steadily from 102 level to 107 level. This shows there is demand for dollars worldwide, because of which dollar is strengthening, and that has impact on all currencies, not only just Indian currency. All currencies are weakening against the dollar, and rupee is also weakened against the dollar. Brent crude price is at $72.98 per barrel. A lower crude price is good for Indian economy. Our oil import bill will be less. That will help to contain the inflation in India. So, similarly, it is good for the oil marketing companies. Their margins will improve. The cost pressure will be less on them. Gold price is at 76,432 for 10 grams 24 carat. So gold price after hitting a high of 80,000 during Diwali has stabilized at around 76, 77,000 rupees. FIIs have sold 15,828 crore during this week, and DIIs have bought 11,874 crore in equity during this week. DIIs have been continuously buying, but uh, DII buying has not been able to match FII selling. That is why we see a sharp fall in the market. But a difference of just 3,000 crores between FIIs and DIIs. Has it resulted in the sharp fall in the market? No, that may not be the reason. In the beginning, I told weak hands are getting out of the market. This is the data indicates that there is a heavy selling by retail investors during this week. The panic selling always creates a bottom technically. The panic selling by weak hands in the market creates the bottom. That is the technical theory. As per that, I have told that markets are somewhere near the bottom, intermediate bottom. One good thing is that direct tax collection for quarter three has gone up by 16.8%. 15 December was the last date for paying advance tax. The advance tax numbers have gone up by 16.8%. The companies pay advance tax. When do they pay advance tax? They estimate their profits based on the profits and their earnings. They pay advance tax. When advance tax has gone up by 16.8%, that is around 17%, what can you expect in the next quarterly results? The company's profits are to expected to go up by 16, 17%. So this is a good news. So this data indicates that when the company's earnings are likely to go up, there is no reason for the markets to fall to a large extent. That is why I say from the current level, uh, further dip in the market is limited. Charts indicate that we are near the intermediate bottom level. The chart and the fundamentals both indicate that somewhere we are near the bottom. Exactly, it is not possible to pinpoint the bottom, but somewhere we are near the intermediate bottom. Based on the macroeconomic data, downside from the current level is limited. Investors can accumulate quality stocks from the current levels. Mutual fund investors should continue their SIPs, hold on to their lump sum investments. They should not fear. The economy is doing well. Our macroeconomic data is good. Companies' earnings are expected to pick up. Q3 results should be definitely better than Q2 results. So there is enough opportunity for getting good returns and being invested. Mutual fund investors are advised to remain invested, continue their SIPs. This is all for this week. If you like my video, please subscribe to my channel. You can refer to your friends. You can ask your questions. We will meet again next week. Thank you.